So, I want to start by saying something that might surprise you coming from a channel that spent a lot of time talking about the RMD time bomb. The fear around required minimum distributions, the way most retirement content presents it, the way most men approaching 73 feel it in their chest, is partly based on rules that no longer exist. And I think you deserve to know that before you make any decisions. Because here's what's happened since 2017. The standard deduction for a married couple over 65 has more than doubled. The tax brackets are wider and the rates are lower. The age at which RMDs begin has moved from 70 and a half to 73, with a planned move to 75 in 2033. And the IRS updated its life expectancy tables, meaning the percentage you're forced to withdraw each year is smaller than it used to be. Put those four changes together, and the RMD picture looks meaningfully different from what men who've been carrying retirement anxiety for the past decade are imagining. So, the first thing I want to say is some of what you're afraid of isn't there anymore. But here's what's still there. The men who wait until 73 to think about required minimum distributions, who assume the friendlier rules mean they don't need to do anything in the years leading up to it, those men are still walking into a tax and Medicare situation that proactive planning could have dramatically changed. And the cost of waiting isn't small. For a couple with $1 million to $2 million in a traditional IRA, the difference between using the years before 73 deliberately and arriving at 73 without a plan can be $50,000 to $100,000 a year in taxes and Medicare premiums they didn't need to pay per year for the rest of retirement. So today I want to do both things at once. Give you the honest picture of where the rules improved, because some of the fears outdated, and then show you why the planning still matters and what it specifically looks like to use the window you still have. By the way, my name is Edward Gray, and I'm a retiree just like you. On this channel, I share what I've learned from my own retirement, my own mistakes, and the conversations I've had along the way. So you can see where you stand and what you might do differently. If that sounds like something you want more of, hit subscribe and become part of this community. And while you're down there, drop a comment. What's your biggest concern about RMDs right now? Tell me where you are. All right, let's go through the improvements first. The standard deduction in 2017 for a married couple was $12,700 plus personal exemptions of roughly $4,050 each. Combined, they were shielding about $20,800 of income before hitting the first bracket. In 2026, a married couple where both spouses are 65 or older gets a standard deduction of $30,000, plus an additional senior deduction that can push total shielded income toward $47,500, more than double the 2017 amount. That matters for RMDs because every dollar of shielded income is a dollar of forced distribution that doesn't produce a tax bill. The brackets themselves are also friendlier. In 2017, the 15% bracket for married couples started at $18,650. Today, that same income falls in the 12% bracket, which runs to $96,950. The old 25% bracket kicked in at $75,900. Today, that income is taxed at 22%. The 28% bracket used to begin at $153,100. Today, that income falls in the 24% bracket with a threshold that starts significantly higher. Not only are the rates lower, the brackets are wider. You can earn more before crossing into the next one. Then there's the starting age. In 2017, RMDs began at 70 and a half. The Secure Act moved that to 72. Secure 2.0 moved it again to 73. And in 2033, it moves to 75. That's 4 to 5 additional years of planning window compared to the old rules. Years where the IRS can't force anything out and you're still in control of what happens with the money. And the IRS life expectancy tables were updated in 2022, which reduced the forced withdrawal percentages at every age. At 73, you're now required to withdraw roughly 3.77% of your account balance, rather than the higher percentage the old tables demanded. The difference sounds small. Over a retirement that runs 20 years with a 7-figure IRA, it adds up to meaningful control over when and how that money comes out. So the rules genuinely improved, and men who are working from 2017, assumptions about what RMDs will cost them are carrying more fear than the current rules justify. But here's where I want to slow down and be honest about something, because this is the part that most calming RMD content glosses over. The improvements in brackets and deductions don't capture the full cost of an RMD dollar. Here's what I mean. When a forced distribution arrives at 73, it doesn't land in a vacuum. It stacks on top of Social Security, which can be up to 85% taxable. It stacks on top of investment income, interest, dividends, and that combined income is what Medicare uses, looking back 2 years, to determine your Part B and Part D premiums. So the RMD dollar isn't just taxed at its marginal bracket rate, it potentially makes more of Social Security taxable at the same time. And if it crosses an IRMAA threshold, it adds hundreds to thousands of dollars per year in Medicare premium surcharges on top of that. Frank, my tax guy of 15 years, walked me through a scenario where a man with $1.2 million in a traditional IRA arrives at 73 with Social Security already running. His first RMD is around $45,000. That $45,000 stacks on top of the Social Security, pushes 85% of the benefit into the taxable column, and tips him into the next IRMA tier. His effective tax cost on that $45,000, when you account with the additional Social Security taxation and the Medicare surcharge, runs significantly higher than the bracket rate alone suggests. He didn't pay 22% on that $45,000. He paid something closer to 32 to 35% when you fold in every other income source it disturbed. And here's the compounding problem. The RMD grows every year. As the life expectancy factor shrinks, the forced percentage increases. A man who arrives at 73 with a large, untouched traditional IRA doesn't face one difficult year. He faces an escalating forced income stream for the rest of retirement, with IRMAA and Social Security taxation compounding the effective rate year after year. That's the part the RMDs aren't so bad argument misses. The bracket comparison alone looks like a wash. The full picture, including what RMDs do to everything stacked underneath them, is significantly more expensive. So, yes, the rules improved, and yes, the fear is partly based on outdated assumptions. But the planning still matters. And the reason it matters is specifically the stacking effect, not the bracket rate in isolation. And that brings me to what I think is the most underused concept in retirement planning: the control window. The period between roughly 60 and 73, between when most men retire and when RMDs begin, is the single most valuable planning window in a retiree's financial life. And most men either don't know it exists or don't use it deliberately. Here's why it's so valuable. During this window, income is often at its lowest point of adulthood. No salary, Social Security possibly not yet started, no forced distributions. Every dollar you pull from the traditional IRA or convert to Roth comes out at a rate that's almost certainly lower than what those same dollars will cost when RMDs begin and Social Security is running simultaneously. The man who retired at 63 uses the window between 63 and 73 to systematically reduce his traditional IRA and arrives at 73 with a significantly smaller pre-tax balance. His RMD is smaller, his Social Security torpedo exposure is lower, his IRMAA risk is reduced. The whole income picture at 73 looks different because he did the work in the decade before. The man who retired at the same age left the IRA untouched because it felt wrong to pull from something that was growing and arrived at 73 with the same balance plus a decade of compounding. His RMD is larger, his stacking effect is more severe, and he has almost no flexibility left to address it. Same starting point, completely different retirement tax picture. The difference is the window. I'm 67, and I've been using the window for 4 years. The annual bracket filling conversions, the deliberate IRA drawdown, the IRMAA check before every decision. That work is building a smaller force distribution at 73 than I'd otherwise face. Frank projects what my RMD looks like at 73 under the current trajectory versus what it would look like if I stopped doing anything. The gap is significant. And here's the specific figure that researchers studying this have documented. Men who use this window systematically can reduce their RMDs at 73 by 40 to 60% compared to men who arrive there without a plan. That reduction compounds through the rest of retirement in lower taxes, lower Medicare premiums, and more flexibility for the surviving spouse. So, what does using the window actually look like in practice? Three specific things, and I want to be concrete about each one because the general concept is only useful if you know how to execute it. The first is systematic annual IRA withdrawals, not random, not reactive, but deliberate bracket filling pulls from the traditional IRA every year during the window. Here's how this works. In any given year, you calculate where your income lands from all sources: part-time work, investment income, Social Security if it's running. You see how much room remains in the current bracket before crossing into the next tier, and you pull from the traditional IRA up to that ceiling. If you're sitting in the 12% bracket with $40,000 of headroom before crossing into 22%, you pull $40,000 from the IRA. You pay 12% on it today, $4,800. That $40,000 never becomes a forced RMD at 73 stacking on top of Social Security at a combined effective rate of 30 to 35%. That's not a complex strategy. It's a deliberate annual decision about which year to pay a tax that's going to be paid eventually anyway. The second thing is Roth conversions, which we've covered extensively on this channel, so I'll be brief here, but connected specifically to the RMD problem. Every dollar converted to Roth during the control window is a dollar that permanently exits the traditional IRA. It never becomes an RMD. It never stacks on Social Security. It never contributes to IRMAA exposure. And it grows tax-free, comes out tax-free, and provides the surviving spouse with a clean income source inside brackets that shrink after the first spouse dies. The systematic version of this and converting the same amount annually, size to fill the available bracket space without crossing into the next tier or the nearest IRMAA threshold, is exactly the approach I've been taking since retiring. Small, steady, consistent. And here's a nuance worth adding that I hadn't thought about until Frank mentioned it. In years where you spend less than you budgeted, your actual expenses come in under what you planned, that unspent margin is available for an additional small conversion at year end. If you budgeted $110,000 and spent $95,000, you have $15,000 of margin sitting there. Converted. It's a low-cost opportunity that shows up at the end of the year when you know exactly where your income landed for the full 12 months. The third thing is coordinating the withdrawal and conversion plan with Social Security timing. The moment Social Security starts, your income picture changes permanently. The low income window doesn't close completely, but it narrows significantly. Every dollar of Social Security that's running is a dollar of additional income stacking on top of whatever IRA withdrawals or conversions you're doing. This means the years before Social Security begins, the years I'm in right now at 67, are the purest, most flexible version of the control window. The bracket space is widest. The IRMAA exposure from conversions is most manageable. The effective cost of moving money out of the traditional IRA and into Roth is at its lowest. Once Social Security starts, the plan doesn't stop. It adjusts. The conversion amounts get sized against the combined income, including Social Security. The IRMAA check becomes more critical because there's less room between the base income and the nearest threshold. But the work you did before Social Security started, the reduction in the traditional IRA balance, the Roth you built, that's already protecting you. Now let me talk about two additional strategies that sit alongside the core withdrawal and conversion work and deserve to be named clearly. Asset location is one. The idea is straightforward. Put slower growing, income producing assets like bonds, CDs, and lower volatility positions inside the traditional IRA. Put higher growth assets in the Roth or taxable accounts. Why does this matter for RMDs? Because the RMD is calculated as a percentage of the account balance. A traditional IRA that grows more slowly produces a smaller forced distribution at 73 than one that's been compounding aggressively with high growth positions. You're not eliminating the RMD. You're reducing the base it's calculated on by intentionally placing slower growth assets there. This doesn't require moving everything around. It means being deliberate about what you add to each account going forward, and about where you hold investments when you have flexibility about which account to use. Qualified charitable distributions are the other. We've covered QCDs before on this channel. The ability to send money directly from a traditional IRA to a qualifying charity starting at age 70 and a half, with that transfer counting toward the RMD without appearing as taxable income. If you're already giving to a church, a university, a hospital, or any cause you care about, the QCD is the most tax-efficient way to do it. The charity gets the full amount. Your MAGI is unaffected. The RMD obligation shrinks. No deduction required, no income reported. For men who are both charitably inclined and concerned about RMD exposure, QCDs address both simultaneously in a way that no other strategy does. So let me land this the way Frank would if he had 15 minutes with a man approaching retirement. The rules got better, the deductions are larger, the brackets are friendlier, the starting age is later. Men who are running fear calculations based on 2017 rules are carrying more anxiety than the current landscape justifies. That's the honest truth, and it's worth saying plainly. And the planning still matters. The bracket improvement doesn't capture the stacking effect. The wider deduction doesn't protect you from the IRMAA surcharge that RMDs can trigger when they land on top of Social Security. The friendlier rates don't eliminate the difference between paying 12% in a deliberate bracket filling withdrawal at 65 and paying an effective 32 to 35% at 73 when the same dollar is stacking against everything else. The control window is the answer to both. It exists, it's real, it's the most valuable planning opportunity most retirees have. And it's available right now for any man between 60 and 73 who hasn't been using it deliberately. Use it. Not in a panic, not all at once. Steadily, annually, bracket by bracket. With an IRMAA check before every move and a frank level conversation about the full picture at least once a year. The men who do this work don't arrive at 73 afraid of the distribution. They arrive having already reduced the base it's calculated on, having already built a Roth that absorbs large expenses without disturbing the income picture, having already established a Medicare premium situation that isn't going to spike from the first forced withdrawal. The RME doesn't disappear, but for men who use the window, it lands in a different place entirely. Drop a comment and tell me, are you currently in the control window between 60 and 73? And if you are you using it deliberately or have you been leaving the IRA untouched? Because that answer right there determines a lot about what retirement looks like at 75 and 80. And if today clarified something that's been sitting unclear, share this with someone who's been carrying RMD fear based on rules that changed years ago. Because the honest picture is both more reassuring and more actionable than the version most people are working from. And if you're not already part of this community, come join us because this is what we do here. Real retirement, real planning, from guys who are actually living it. Hit the subscribe button and ring the notification bell. See you in the next one.